and if I die, I win the bet and my family gets all the money. Hey, you can actually like grow money inside a life insurance policy. I built a multi-million-dollar agency there, almost 200,000 a month.
A lot of people don't really sit down and think about.
They are hoping that you're healthy. By the way, so by being in the market, you're actually the one missing the opportunity.
With life insurance, there's a ton of controversy.
Most people don't have the long-term mindset. And when I kind of needed some money, I didn't have any access.
So having both, having that liquidity and access to that safe money. What's going on, wealth builders? I got an extra special guest with me here, Michael Garcia. He's got an amazing story to tell, and I just wanted to have him hop on and kind of walk us through his experience, but not just that, just how he views insurance as a whole and how it takes place with our finances. So, Michael, without further ado, just kind of give us a lowdown of how you got into this industry and, tell us a story of where you're at now.
Yeah, I got in the industry, Charles, mostly for my daughter. Back in 2014, I became a single dad with sole custody, and I was working with Semper Energy, a Fortune 500 company, in the management team. And, it was a six-figure job, but I had no time. And so what happened was I started realizing I need more time or control of my time. I was at work all day, dropping my daughter off at 5 a.m. My mom was helping me out, and she'd be, say, asking Michael, what time are you coming home? Alyssa's waiting for you. And didn't know. I didn't have an answer, right? It was like whenever they let me go home. So kind of that's actually what caused my search. My first business venture was actually network marketing, which, I still believe in the power of network marketing today. I think it's an extremely, powerful idea or concept. However, if you know network marketing, Charles, like you have to have a huge team before you make any money, right? It's like, it takes a while. And one thing that I understood was, I started seeing people come in, and then 3 months later they'd go out. And what I realized is most people don't have the long-term mindset to actually build out network marketing. And so about a year in, I saw insurance and I saw the financial services industry. I saw the ability to make commissions while you build your team, while you do, build your agency. And I thought, man, that just makes sense, right? People will stick around if they're making money early on. So needless to say, I got into the financial services industry. It was the first time somebody sat down with me and asked me some serious questions. I used to be pretty ignorant when it came to life insurance, Charles. And I've told you this, but I only knew about term insurance before I got in the industry. And so I always used to look at it this way, like, well, that's pretty dumb, like so I'm going to place a bet, and if I die, I win the bet and my family gets all the money. And if I live, I lose the bet and I'm just out of money. Like it didn't make a lot of sense to me. Right. And it wasn't until someone sat down with me and had a serious conversation and said, Michael, what happens to your daughter if something happens to you? And it really caused me to like pause and think like, man, what would happen? Right. Where would the money come from? And needless to say, once I, really understood what life insurance was for and what it was all about, I got 2 policies that day, over $1 million of coverage. And the main reason was I wanted to make sure my daughter was covered. Should something happen to me, hey, guess what? She's taken care of. And so I got really passionate about life insurance. That was also the day I got introduced to cash value life insurance, albeit a type that I don't sell anymore. But that was the first time somebody told me that, hey, you can actually like grow money inside a life insurance policy, right? The tax benefits and all these things. So as far as I got in the industry, I took about a year. First year, I didn't make any money. Was learning, building my skill sets up. And 2 years, I started with family first. After 2 years, that's actually where I took off, Charles. I built a multi-million-dollar agency there. We had about 35 writing agents, like another 25 agents that were actively, showing up to trainings and stuff, but maybe weren't as active in the field. But yeah, we were clearing about 200,000, almost 200,000 a month. And so we were a multi-million-dollar agency, did pretty well. And but ultimately, I lacked control. I lacked certain things in there. And so what I decided was, hey, I have the skill sets. Why don't I just start my own company? And that's where IC Life comes from.
Well, I got to say that your trainings and your leadership ability with all of your recruits, I think, is really top notch. And I can tell that your heart's in the right place when you're helping these people. You brought up some good points, though, especially around the whole life insurance thing. A lot of people don't really sit down and think about what would happen to their family if something were to happen to them, especially if they're the breadwinner. They just think, oh, everything's going to be okay. And the thing is, we don't know what tomorrow holds. And so having a policy, whether it's term or permanent policy, it's really just making sure that no matter what, your family is protected. And so I urge you guys, if you're watching this, to really, if you haven't already, just sit down and think about what would happen. If you don't have something in place, if you don't have a lot of assets, what would happen to your family if something were to happen to you as a breadwinner? Now, you have this, amazing agency, right? IC Life. It's a fast-growing agency. We'll make sure to have the link below to how people can get a hold of you if they want to join that agency. But, with life insurance, there's a ton of controversy out there, a ton of controversy. And where do you think that stems from? And, what are kind of your views around how insurance fits into somebody's finances?
Yeah, I think, just to give you an idea how serious I take my insurance, I look at it this way. If I, you make your priorities, right? And so if I were to prioritize, I actually place my life insurance almost at the top of my budget. And the reason for that, Charles, is if I were to pass away today, let's say I had to choose, like, what do I pay on time, right? If I pay my car payment on time and not my life insurance, my daughter gets a car she can't drive, right? If I pay my rent on time and not my life insurance, well, she's going to get 30 more days to live in a place by herself that she's not going to live in anyway, right? But if I pay my life insurance on time and before the other two, she's going to get a big lump sum of money that's going to help her in her future. So my mindset is like, hey, my life insurance is for her, and it's more important because it is for her than my rent, than my car payment, than really any of the other bills, other than bills that make money. But most people don't have that mindset, right? They think about today and just today. It's not a long-term mindset. So that's how I see it. I think the controversy comes from if you look at how Primerica started, right? A.L. Williams, most people know this story. He got really mad because his mom had a whole life policy and, he didn't feel it was enough coverage. And he's like, man, if she would have had a term policy, she would have had more coverage. Is it true term is cheaper? Absolutely. May that not be the whole story, though? May the mom have wanted it for a different reason?
Yeah.
I don't know, but I think, people have their own views. I've heard people say, oh, my parent, my mom or my dad paid all this money into a whole life policy and then, any kind of policy, universal life, and they didn't get the huge payout we thought they were getting. Well, maybe they borrowed from it. Like maybe there's other pieces to the story. And so I think that's part of it. And then what I see right now in the industry, it's a lot of misinformation, a lot of agents selling life insurance as something it's not. And it's going to just give it a bad name because, how it's not going to perform the functions that you think it's going to perform. And it's not that the policy is bad. It's going to do what it was supposed to do.
100%.
Right. But it's not going to do what you sold it to do. and that's the problem. People are buying it for the wrong reasons.
I agree. And I think a lot of it has to do with, the misinformation part. A lot of it stems from just lack of understanding the way these products work, right? And that it gives the industry a black eye because people are touting, and pushing this product and saying that it's going to perform a certain way. And there's no possible way. There's no mathematical possible way that any of it will pan out the way a lot of people present it to be. So that's what I think is so important with you is you're presenting it and you're educating people. This is where it fits in to your finances. Now, Michael, it's my understanding that you got into the industry and you started selling IULs. So where do IULs fit into someone's finances and how do they work?
Yeah, so it's actually a funny story because, I think this is one of the biggest black eyes of the industry right now is people are selling IUL as a tax-free retirement, and it's rampant. It's everywhere. It's on TikTok, on social media, all platforms. And reality is no life insurance. None of it is a retirement plan. And if you take nothing away from that today, and you're looking at life insurance, please understand that it's not a retirement plan. They're just using marketing tactics to get you to buy. But IULs are flexible premium life insurance, and that could be good and bad, right? That could be good and bad. You can have some flexibility in your premiums. However, that flexibility can get you in trouble because the policy does have an increasing internal cost. And so if you're not funding the policy properly, most likely what's going to happen is you're going to get a letter later on, and the insurance company is going to say, hey, you have to up your premiums in order to keep this policy alive. And honestly, by that time, Charles, just let the policy go. You're fighting a losing battle because those are only going to increase every single year. But yeah, as far as a couple areas it can fit, they can make solid legacy plays. There are a couple IULs out there. One is as a protection. It's a guaranteed death benefit. They can guarantee it up to 120. It might be cheaper than whole life. However, an agent might tell you, oh, you get the cash value too. Well, not really, not really, right? Because there's certain guarantees, and once you start borrowing from that policy, those guarantees do go away, right? The contractual guarantees. There's certain minimums that you have to meet, and it's kind of understanding this. It's you ever heard the proverb? If you chase two rabbits, you catch none.
I have.
So when you're trying to look at the policy, especially in IUL, as both death benefit or accumulation, the reality is if you try to get both, you're guaranteed to lose both, right? And so you can get those guarantees and protections, and it could be a lower cost. So that would be one area where maybe somebody, maybe not a great budget, could get a permanent death benefit, maybe some living benefits.
Gotcha.
And the other way is like the total opposite, where you fund the policy beyond what these people are telling you to fund it. It's called a MEC, a modified endowment contract, and you can mathematically guarantee it by making the insurance portion so small that the minimum interest covers it.
Gotcha.
Right? Now, do you get to borrow from it tax-free? No, you don't.
Because it's a modified endowment contract. So you lose all those tax advantages there.
Well, you lose that tax advantage. Yeah. So the reason it could still be a decent idea
the death benefit.
Is because the death benefit is still tax-free. So someone ultra wealthy that just has a ton of money that they're like, hey, I don't want to touch this. This is going to the next generation. That could be a place to put it. It can still grow. You get the tax-free death benefit, and if they add some living benefits and they need it for, medical emergencies, they can get that tax-free as well. So there's still a few cases. I think it's actually more of a niche product when you really think about it, though.
Yeah, but it's pushed as a mainstream product, which is going to hurt a lot of people, and we'll dive into that right now. Now, people say, there's a lot of people that will say that you can't lose money with an IUL because there's floors involved. But can you explain how you can lose money? And can you also explain what are the risks involved with a product like an IUL?
Yeah, so you won't lose money due to the index. The index will never perform negative. The issue is the internal cost of the policy, and not just that, but the rising internal costs. So you're never going to see this when you buy it when you're 30 years old and you're funding the policy. At that point, you're covering all the risk with your own premium every single month, and then some, right? So it's not going to be an issue. Now, when you're older, and if depending on how tight you close that net amount at risk, that cost could be minimized, right? But most policies are not set up to be minimized.
Yeah,
right.
They're designed to pad the pockets of the insurance agent.
Right. And what's going to happen is just those costs alone can cause the policy to lapse.
Gotcha.
Right. It's going to eat up the cash value. But then what happens is, it's the way it's being sold. People are going to compound that by now borrowing against the policy. And now you're going to add a 5% interest. That's going to compound against you year after year. And, when you really think about it, people are selling the policy as tax-free retirement because, what are you going to pay in taxes when you're 60? And you probably agree, Charles, like you probably think taxes are going to be higher by then, right?
I do. Definitely.
Yeah, I do. I think you look around at the national debt, the unfunded liabilities of this country, and you kind of just put two and two together and you think, man, taxes have to go up at some point. But that's where they scare people, is they tell people, well, what if you could do it tax-free? But what they don't tell you is that 5% charge that's going to compound against you, right? And to be clear, I'm just speaking generally.
Yeah.
There are some good agents out there that will explain this to their client.
Even good agents may not have all the facts, so they still may be giving you misinformation, and that's unintentional. So it's important to consider that too.
Right. But yeah, that 5%, if you just picture this, if you took a loan out and you started taking income at 60 years old,
and
then you got charged 5%, and then the next year it grew and you got charged 5% and compounded on itself, right? And you've lived 30 years. Do you know how much interest, Charles, you'd be paying after 30 years?
A hell of a lot.
That 5% compounds to over 300%.
Wow.
Almost 350%.
Wow.
And so when you really think about it, it's like, is it worth skipping the taxes at one time?
And you'll hear the argument that the index will make up for that. But like you're factoring that the index will continue to grow that cash value and work against that interest against your loan. But what happens when you're in zero years? When you're in 0 years, that's not continuing to grow. So now your cash value sits at zero, and then that loan is working against the whole policy itself.
Right. The insurance companies, now there are uncapped indexes, but go to my channel, check out how those uncapped indexes work, because they're not what you think they are. But the best option is the S&P, and you'll catch that in my video the index video I did. But the S&P is going to give you the best results. Now, typically they're capped maybe 10%, right? And the other part that sucks is the caps on the new business illustrations are always higher.
That's
like 95% of them are always higher. And then after a few years, they lower your cap. So even a 10% cap, I want you to imagine, you have all these costs in the policy. It's based on the positive arbitrage that the illustration shows. And so it's counting on a credit every single year from the index. So when the index does zero, that credit doesn't come in, and those costs still happen, right?
They still accrue.
Yep. And so this is where these policies, you can see them take 20, 30, even 40% losses in 1 year with no chance of recovery because of the caps.
Because the caps don't allow the recovery.
Right.
So you brought up a good point, and that's that, these IUL companies will do a bait and switch on you. So they show you this amazing illustration and they show you that you're going to have this cap rate. But the thing with an IUL and the contract within an IUL is that they can control the levers. So what you'll see with the majority of the companies out there's a couple that don't do this, but they'll bait and switch you. So they'll show a high cap rate in the beginning, and a few years later, they'll switch it to a lower cap rate. So there's no possible way that the original illustration that you were presented will ever perform that way. And, that's just a misrepresentation of how the product is working. And it's one of the reasons why I really advise against getting an IUL based on those different factors. Now, it's my understanding that you used to really be a proponent of these products, and then you made a switch to
Yep.
whole life. You're a big proponent of whole life now. So walk me through like what led you to that decision.
Yeah. So, the company I came up with was actually WFG, and they're a big proponent of IUL. And I mentioned I had never even known I didn't even know there was cash value in life insurance, right? And so when I saw that and the way it was presented to me, and you can't lose, I was like, man,
It's a no-brainer.
this is the greatest thing since sliced bread, right? Like, this is amazing. And then I started to learn a little bit more, and I remember, honestly, about a year and a half in, I kind of realized like I knew just as much, or even maybe more than my mentor in some areas, right? And I was very hungry for the knowledge. And when I built my agency with Family First, we focused on IUL still,
Yeah.
and I kind of became like this IUL expert that people would reach out, like, "Hey, can you design this for me?" And I would do trainings on how to mitigate that risk. Right? We have to fund it this way. We have to make sure that the kind of that corridor where the cost of insurance is minimized when they reach retirement. I definitely built it a little differently than what most agents would show you, but I found it more effective.
Gotcha.
But ultimately, what caught my eye was I always had this belief, like, okay, I'm doing all these things to mitigate the risk, and it's going to work because we took care of one cost. But it was really when actually I found Chris, and I kind of found him by accident. I was actually looking up, trying to get more information on Mass Mutual and Guardian and the differences, and kind of where each company is stronger.
Gotcha.
Because I had some whole life experience, but I didn't have a whole lot, right? And anyways, after that video, you're on YouTube, you got to go down those rabbit holes, right?
Oh, exactly.
And Chris Kirkpatrick came up, Life 180, and he showed a video. I was like, man, that's really good content. And it actually made sense, because the one thing that I never understood up until that point was, well, why are there like generations of policies? Right.
Yeah.
Why is like when you go to the illustration builder, there'd be like a 2022, 2019 version, a 2015 version. And so he was explaining how they block their business. And so not every generation gets the same rates. Only the new generation gets the best rates. And I was like, oh, that makes sense. That's why they're doing that. Okay. And so the second video, he told his story, and I was like, oh man, like, he's not even licensed. Like, he had to give up his license in order to tell the story.
Yep.
And that's what really caught my attention, because, what made me realize, like, he's not about the money.
Yeah.
He was about like doing what's right and getting the right information out there so people won't be hurt. And so, needless to say, dude, I watched like 8 more hours of his content. I was actually on a drive, more listened than watched it because I was driving. But there was one video in particular, and he showed just what the money borrowed and that interest that compounds against you. And he showed an example of a not a bad policy, like as far as like
the design,
like the funding of it, the money in there. But it still lost 40% in a year that didn't get any interest.
Yeah.
And when I saw that, you just do the math. You like lost 40% one year. The second zero is going to be bigger because now there's more costs against it, right? And so it made me realize, like, the 2 bad years could knock you out. And people are telling people to put their whole life savings in this.
And not just knock you out, but stick you with a huge tax bill too.
Yeah, if it happens before 75, in most cases, you're going to get a big tax bill. And it really changed. And it was kind of frustrating too, because people had come to my team for me to train them on how to sell IUL, and that's why they were on my team.
Yeah.
And now I'm looking at this product, I'm like, how do I sell this? I don't know. I actually went through this phase where I called all the insurance companies. I was like, tell me about your riders. Tell me how the clients are protected from this. And I couldn't get any satisfactory answer.
So you're stuck with this moral dilemma at that point, right? And you're kind of going, what do I do now?
Yeah. Yeah. And ultimately, I decided I had to have some conversations with people and say, hey, check. Actually, what I did was I started sending them the videos first.
Gotcha.
To kind of like prep them. like, like, so they had this information like, hey, what do you think about that? And I think we should probably step away from this, and like I said, I went through my own research. I was like, there's got to be an answer. I didn't. Yeah. I've been selling it for 4 years. I didn't want to give up on it just that easy, right? And so, all the big companies, Allianz, North American, F&G, all the popular ones, like I called them all. More than that, but couldn't get anything that satisfied, my concern.
Gotcha. So you have this moral dilemma, right? And now you're just kind of stuck in a place. What do I do? And you figured, after watching Chris Kirkpatrick's content, that maybe whole life was the answer. And so what is it about whole life that you think is better? And how does whole life fit into someone's finances?
Yeah. So the one thing that had to change was I stopped selling life insurance like a retirement vehicle.
Gotcha.
Because the reality is whole life is a bad retirement vehicle too. Right. So it's not that I just switched out like whole life or IUL for whole life and kept selling it the same way. I actually had to change the whole concept of how I sold life insurance. Right. And
it's a huge shift because, you've been learning how to present it in a certain light.
Right.
And now you're going, okay, well, I got to go back to ground zero and figure out how this actually works for people.
Yeah. So what I realized was it's, you can compare life insurance more to a savings vehicle than an investment vehicle.
Gotcha.
Right. And it's not going to be the retirement. It should never be, life insurance should never be your retirement plan. Like it can be a piece of it. There's definitely some parts that it can fit, right? It can be a volatility buffer in retirement.
Yep.
It could be like a bond alternative, right, or a savings alternative. But what I changed was the concept of how we help people with their money, and giving people control. And this was actually something that was kind of painful for me because obviously I got sold an IUL, being that's where I came from, right? Yeah. And so I had this IUL and I had this cash in it. And when I kind of needed some money, I didn't have any access to any of it because it was all under surrender
charges,
right? And so what I liked about the whole life was, wow, there's no surrender charge. Like I can almost put the money in and I can turn around and borrow it if I need it.
Yeah.
And so that was what shifted. It's like, no, it's control because I have my capital liquid.
Gotcha.
And I really value control because that when opportunity knocks, like it only knocks for a window of time. Yeah. And if you miss that window, it's gone. And so there were a couple opportunities in my lifetime. Actually, one I took advantage. I bought a home when I was 24 years old.
Okay.
I ended up selling it a few years later after I went through a divorce and became a single dad. But a big reason why I made that decision was I didn't have any access to capital. All my capital was in 401k. So it was under taxes and penalties. And it's like, oh, that's not liquid money, right? And could I have taken it? Yeah, I could have.
But you would have been hit with a bill.
Right. And so you're only getting a portion of what you think you're getting.
Yep.
You get hit with the tax bill. And so I didn't want to do that. But had I had the access to capital, I probably would have this property today. And that property is in Laguna Hills, California.
Okay.
And it's probably about $600,000-$700,000 right now.
Yeah.
By the way, I was paying extra on the mortgage, which was only $1,600.
Oh man.
So even just the inflation protection, you look at the rent today, I could rent it out for $3,100, $3,200.
That cash flow.
Yeah. And it could be paid off at this point. I miss other real estate opportunities. My uncle told me to, position myself for certain opportunities that were coming up, even within the family. Because, people die and it's not the way you want to think of it, but how do you not let the properties and the the wealth built by the previous generation.
How do you not let it go? Exactly.
How do you not let that go, right? And so I wasn't in position for that either.
Gotcha.
So I kind of estimate I probably missed out on about 800 to 1.2 million, and that's without taking into account, like maybe I would have borrowed and bought even another property or done another investment.
Yeah.
Just in that alone, I kind of estimate I missed out on that much. So I really value the control, the liquidity and having the access to capital. And so now that's what I talk to people about. It's like,
cool.
Do you really want to put your money somewhere where you're not going to be able to touch it? Or if you do, you're going to be penalized for it?
Yeah.
Or do you want to build a foundation where you have access and you can go make the investments that you want to make, right? That you have control over.
100%.
And plus, I'm a big believer in cash flow versus accumulation. So, it was just a shift in mindset.
Gotcha. So with your whole life policy, right?
Mm-hmm.
With an IUL, all of the risk is on you, right?
Right.
But where's the risk when you have a whole life policy in place?
Yeah. So the risk of a whole life, it's really on the insurance company. That's the whole definition of insurance. So anyone who's taken the insurance exam like we have, they've read it right in the content. The definition of insurance is to transfer risk to another entity, right? And so you think about, you buy car insurance. Well, what happens if you get in an accident? Do you have to come out of pocket for that, or does the insurance company? So it's all about transferring risk, right? And so whole life transfers that risk to the insurance company. And by the way, so does term for a limited number of years, right?
Yep.
A certain time frame. IUL does too in the beginning. However, in order to make the policy work, you have to use your own capital to actually lower the net amount at risk and minimize it for the insurance company. So it's a big profit center for the insurance company. Whereas whole life, every premium you make, and when you overfund it, it goes into PUAs, it buys more insurance.
Gotcha.
So actually the insurance company is taking on a little bit more risk each time. And then they have guarantees. They don't have the same levers as the IUL where they can say, okay, well, we have all this risk, so we're gonna lower this. Charles, I don't know if you saw this on social media. I posted one of the companies dropped one of their caps to 1.5%.
And if that's the case, like, how is that policy supposed to perform?
Yeah, and not only that, but you can go to the bank and get that right now.
Yeah, easily.
Right. We can get clients 5% guaranteed for 10 years
with no risk, no fees.
Right. And this was a fixed index annuity, so you just have to. It's not just the IUL that has some the ability for the insurance company to change things. You got to pay attention, and so that's why I think picking the right company too. Even for like a fixed index annuity, you got to make sure the reputation is there. Highly rated, all the fundamentals are good, because I think people kind of skip out on the fundamentals of the company, and are they financially stable? Are they strong? There's some companies out there that have A ratings, and then you go and you look up their assets to liability, and it was like they're upside down.
Yeah.
Like how does this company have an A rating, right? And so, but that's something people don't do at all.
So why can you trust the whole life companies? Like, what is it about the companies that you utilize that give you so much confidence in the future?
Yeah, honestly, it's the contractual guarantees.
Okay,
so that right there is everything to me. But it's also the fact that the policies we use are sold through mutual whole life companies.
Gotcha.
So if the insurance company profits, we profit.
Yep.
We get dividends, right? And so it's actually, you own the insurance company, the policy, the whole participating whole life policyholders have ownership of the company.
Partial owner.
Right. So now, instead of sitting on the opposite side of the table as the insurance company, where if they have to pay out the death benefit, like think of a term policy.
Okay.
They are hoping that you're healthy. By the way, insurance companies are one of the only businesses out there that hope you live a happy, prosperous life. Right? Yep. Like, think about it. The doctors want you to get sick, right? Everyone wants you to have some kind of pain point, but they want you to be happy and not have to pay out any claims, right? And so if you think of a term policy, they take on that risk. They want you to live. If you die, then they have to pay out this big claim, right? So they're taking that risk and they lose, but your family wins, right? If you live, then they win. They get to keep all the premium, and you're kind of okay. You paid it, and not to this term because I own term, by the way. There's a place and reason for it, but you have to understand you are on the opposite side of the table as the insurance company. Whereas in your whole life policy, you're on the same side. You're owner. So if the insurance company profits off the term or whatever other products they sell, guess what? It benefits you. They have the general fund where they grow the money, very, very safely. That's what they're best at. You're going to see about 5% growth. And guess what? That benefits you because you're part owner and you're going to get paid out a dividend, each year. And by the way, the dividends are one of the safest bets. They're not guaranteed, but you look at the history and these companies have paid for 150 years.
That's huge. So you're saying that life insurance, and it's like when you look at life insurance and you're looking at it as a retirement income vessel, you're saying that it's not a retirement income vessel at all, but where does, a whole life policy fit into your retirement?
Yeah. So while you build your portfolio, it's a foundation, right? It's like I have this money, I have it accessible to me. I can go build a portfolio, whether it's in real estate or, hey, the market just crashed. And now I strategically position myself to go buy when everything's on sale, right?
Gotcha.
And while everyone else, people, the math is funny when it comes to losses and gains, right? When the market drops 40%, well, you need a 67% return to break even, right? And so, well, what if you were not in the market when it dropped 40% and you were buying in, you saw it just drop 40, you're like, oh, it's time to buy. And now just for everyone else is breaking even, you just had a 67% return. And when it goes above and beyond that, now you're talking about 100, 200% returns, right? And so you can use it as a foundation to go out and then build your portfolio. And then when you get to retirement, obviously you want to have everything, paid back and funded. But you can use it as a volatility buffer. So let's say you do have that portfolio and maybe some of it's in stocks, right? Or you like the stock market. So, the stock market just crashed again, right? Well, do I want to sell when things are on sale or do I want to buy when things are on sale?
I mean, if you're in the market, it's called sequence of returns risk. You do not want to take a distribution
right
when things go down.
Well, now I have my whole life where it's been growing predictably, and I can actually take money out of there for those years and give my stocks a chance to recover. Right. So that way my retirement can last longer.
Awesome. So there's actually science and there's these things called Monte Carlo simulations that scientists utilize to create different models of, different market environments and what would happen in these different scenarios. And what they've shown is that when you have that whole life policy and you have money in the market and you utilize them properly, that you'll actually have more money. You'll be able to take bigger distributions in your retirement and also leave a bigger legacy to your family because you're able to use those sequence of returns risk in your favor instead of if you just had maybe your 401k or just money in the market, which is one of the worst ways to take a distribution in retirement. So having both, having that liquidity and access to that safe money in your whole life policy just amplifies the investments in the marketplace. And it just makes it that much more powerful for your overall financial picture. Now, with that said, walk me through how you feel about the buy term and invest the difference philosophy.
Yeah. So buy term and invest the difference is a saying made famous by Primerica.
And when was that? Back in the 80s?
Back in the 80s.
Okay.
Yeah. So
those big shifts that happened back in the 80s.
Yeah. You had a bunch of money coming into the market, right? 401ks and
the birth of 401ks.
And so you had these huge returns. So But, I think it was actually a great idea at the time.
Yeah.
Right.
Makes sense.
And when you look at the returns since 2000, right? Well, not so good.
Yeah.
Right. And so, do I think there's a place for it? Absolutely. I think, there's certain families out there that maybe their budget's about $200, right? And when you look at their needs, maybe they have a house, they have kids, they have people dependent on them. If you bought just a whole life insurance policy or even an IUL, you're going to be underinsured. So if something happens to you, your family's only going to get so much death benefit. So that's where term comes in, right? You can get a massive amount of coverage for a very little premium.
Okay.
And so I'm a big believer in term, especially when you're younger, as part of the portfolio.
Gotcha.
I mentioned the day when I got my first life insurance policy, I got two.
Okay.
Well, one was to grow cash value.
Gotcha.
And the other one was, well, that cash value is great, but I don't have enough coverage if something happens to me. So I want to make sure I have more coverage. And term's the best way to do that. So, big believer in term. And then I think, you look at how the money grows in the policy, especially for somebody, with a smaller budget.
Okay.
It's not we can't fund the policy. We can't do a whole lot, right? So it's like, hey, why don't, and if you try to make them fit a cash value life insurance, well, number one, you're going to leave them with not too much money, but number two, you're also going to leave them underinsured.
Yeah. And
so that's where that buy term and invest, the difference comes in
play,
because, hey, we can get you a massive term policy for $40, $50. We can get you $1 million policy so your family's covered.
Yep.
And now let's take the rest and let's go put it somewhere. Right. And so that's the buy term and invest, the difference. So I look at it as ideal for people with, really tight budgets.
Gotcha.
And then, I'm still a believer. I buy term and invest the difference.
Yeah.
However, I do that after I fund my cash value.
So you're doing all three?
I'm doing all three. Yeah.
Yeah.
Mm-hmm.
Now, so with buy term and invest the difference, the problem that I found with that is that when you're putting money in the market and you just have term, right? A lot of people will say that they're saving money when they put their money in the 401k or in the market. But when you're putting money and it's exposed to risk and it can go down, you're not saving money, you're risking money. And so the way that I view it personally is that get your term policy in place for your family. And if you can't afford a whole life policy, get a convertible term policy that you can convert to a whole life policy. But then once you've started generating enough cash flow to fund a whole life policy, get a whole life policy and start creating that as your base. So instead of putting money into, funding fully your savings account, put money into your whole life policy and create that foundation to stem from. And then as your cash flow increases, start putting your money in investments, in the market or the 401k. And when you have that financial structure, when you have that foundation, you're playing the long game and you're going to be able to weather the storms in the future, right? Because, the economy goes up and down. If you lost your job, you'd have that whole life policy to pull from. There's a huge percentage of people that have tapped into their 401k. And when you do that, you lose all of the benefits of that compound interest. And that doesn't include the fees and also the taxes that you're going to pay from withdrawing from that. So having that whole life policy as your foundation is just a much, much more profound financial structure than doing the buy term and invest the difference. So overall, that philosophy, like where do you stand with that whole idea?
Yeah, well, the biggest thing for me, Charles, is the opportunity cost. I'll never put money in a 401k.
Okay.
Well, I'll never have a job to do so ever again. So that's part of it. But I would let's rephrase that. I would never put money in a pre-tax qualified account ever again.
Gotcha.
And the reason I say that is because the control, right? The missed opportunity costs. And I was actually talking to an agent. I think he's a Primerican agent believes in buy term invest the difference. And
Gotcha.
like I said, I have nothing against it,
Yeah.
right? But he said, well, you're missing the opportunity by putting your money in whole life. I was like, no, brother, I'm not the one missing the opportunity, right? Because guess what? That money is liquid.
Yeah.
I have access to it. So when the stock market crashes, I'm ready to pounce on it. However, when you are in the market and you go down with the market, you don't have an opportunity when the market crashes. So by being in the market, you're actually the one missing the opportunity if you're fully in the market, right? Because the opportunity is there when things go on sale. And then not only that, but I mentioned the real estate I missed out on. So that was a big missed opportunity too. So for me, the issue with the buy term and invest the difference, like I said, I think it's good for people with a very limited budget. But for me, it's the opportunity cost because you're going to miss out on a lot.
100%.
So
it's been a pleasure having you on the show, Michael. Tell me, how can people get a hold of you? Let's say if they're looking for a policy, or maybe they're looking to join your agency and really increase their income.
Yeah. So I started my YouTube channel as well. So you can find me at IC Life on YouTube. By the way, it's letter I, letter C. Gotcha. So it's not the word, but it's exactly as it reads. It's about seeing life with abundance. It's about vision for a better future. And so you can find me on YouTube. You can also find me at Michael Garcia on Facebook, or you can find my website starticlife.net.
Beautiful, and all those links will be in the description below. So check Michael out. He's a solid guy, and I'm excited to see where he's going in the future. Until then, catch everybody next time.